But I can look at this, I can look at this high and I say, you know what? How much money might it take for me to drive the market from here to just past these highs right here? How many offers do I have to take out to do it?
Just tally it up.
Just tally it up and see if you want to spend the money. Because in essence, how much risk are you actually taking? See, by driving it up, what you're doing is you're increasing the asset value of your portfolio. So in that sense, you're not taking any risk. You're actually making money. If I continue to drive the price up, I am actually making the trades that I made down here winners. Every tick that I drive the price up, I'm making myself a winner on the trades that I made at lower prices. To actually drive a price up because you are making yourself a winner at the prices that, you know, what you bought at lower prices. If, for an example, by me driving this price up, it draws other people into the market, that will help, will it not? Because it creates more of an imbalance. Now, that's the real thing. What I want to do is I want to get more buyers into the market. And the reason why I want to get more buyers into the market is so somebody is there to take the other side of my sell orders. Because that's ultimately what I'm doing here. What I'm doing is I want to sell. So what I'm doing is creating a bigger pool of orders to come into the market till I can sell into, so that my sell orders don't drive the price down. And so I will purposefully do the opposite of what I want to do, ultimately, with respect to my position. Now, the reason why I'm selling has nothing to do with this chart pattern. Absolutely nothing to do with the chart pattern itself. I'm just using the chart pattern as a means to maximize my profits. Now, what if I managed to drive it up to resistance? Chances are there's going to be a lot of sell orders coming in that I'm going to have to compete with. That's a risk that I'm taking here. But what if I can drive it a little past that resistance? What I'm going to have is a situation where all the people, the other traders who sold at this level right here, that came into the market because it was approaching this previous high, they're going to put their stops a little bit above the market. Now, what kind of stops are they going to be? They're going to be buy stops. If they sold to get out at a loss, they have to be buyers. If I can drive the market to those buy stops, I have given myself an instant pool of orders to take the other side of my trades and get me out at maximum profits. This is typically what you see in a chart pattern as a false breakout. Because what will end up happening is that as soon as my order hits the market, it's so large, and then because there really weren't that many other traders that were willing to continue to bid the market up, what it'll do is it'll take out all the bids and then drive the price right down. That's called a false breakout. It's being done at different time frames all of the time.
To do this, you have to have a large enough position so that when you drive up your cost basis, it's incrementally small compared to where you really are today.
Yeah.
And then, as you said, you get up to either you do it below that resistance, hope you break above, and then you just dump your shares.
Right. Right. Thank you. Now, like I said, this is. Did anybody ever wonder why, like you have a really strong bull market or a really strong bear market, and the market seems to open up in the morning, like in bull markets it opens lower, and bear market it opens higher? Like, why does that happen? Well, what's the deal with that? What do you think's going on? You ever heard the term shaking out the weak longs and the weak shorts? That's what dynamic traders are doing. They're shaking out the weak longs and the weak shorts. In other words, they're taking their spot. Because what you have in a bull market is you have, people that, as the market's going up, because this is a daily bar, but if we made it an intraday bar or whatever, as the market is going up, they're buying, people are buying, but they're not like really confident about what it is that they're doing. Now, in the morning, before the market opens, there might not be that many bids. In other words, after the market opens, there'll be more bids that come into the market, but before the market opens, there might not be that many bids. So if there aren't, what these dynamic traders will do to take advantage of this is they'll hit those bids. In other words, they'll sell into those bids, drive the market down, And then when the market opens up, all of the weak longs, meaning people who aren't that confident, will start to get a little frightened, and to get out of their position, what do they have to do? They have to sell, and these other dynamic traders will take the other side of their sell orders to buy and increase their position, and the market goes right straight back up. All they did was shake these guys out, take their spot at lower prices by forcing the market lower on the open. Go ahead.
Isn't this an argument to have to either not use? Let's talk.
No. It is not. No,
You know
I don't
where
want to
I'm
get.
going?
I don't want to get into the use or not. Absolutely, use stops. I'm not going to. We're not going to get into that. Yes, as mechanical, passive technical traders in the mechanical mode, this is not in any way saying that you should not use stops. Absolutely, it's a disastrous thing to do. Not use stops. Okay, because I'm not saying that regardless of any of this that you can't make money. All I'm doing is giving you examples that there are people out there who will drive prices up and offer them lower, that they have the psychological and financial resources to do it. And the reason why I'm making so much emphasis is that the typical passive technical trader would never conceive of actually bidding a market up. And so as a result, it's very difficult for you to think that anyone else can do it either, when the reality is that's the only way in many cases you're going to make money. And so the point that I'm making is that you're trading off of a mathematical formula. Literally, you're trading, and this mathematical formula, what technical analysis does is it gets into the collective mind of the market. In other words, every tick, every uptick and every downtick is information. That information is accumulated and mathematical principles are applied to it. There are actual patterns that emerge, that repeat themselves over and over and over again, that you can identify with mathematical formulas or with these visual price patterns. But the problem is that there's no mathematical formula that can get into the mind of the individual traders who actually are driving prices up or offering them lower. But if you don't know that, you somehow or another, if you're trading on a smaller time frame, and you get a little pullback right here, okay? And based on that pullback, your methodology says, okay, it's time to buy. And you do. And you do it just before this hedge fund manager comes in and starts driving the price up. See, you're going to think that the reason why you won is because that your mathematical formula told you what was happening next. And that was the reason why it happened. What I'm saying to you now is that there almost isn't any reason that you could come up with, whether you won or lost, that would correspond to what really happened in the market. Do you hear what I just said? There's almost no reason that you will come up with to put on a trade that will ever correspond with the actual reason why the market went up or the market went down, other than the fact that there was an imbalance in conviction between buyers and sellers. Because the people who do this will not tell you unless it's in their best interest to do so. And the people who report it in the news agencies, they don't know either. They're making it up. They make up the reasons because they sound reasonable. They are paid to sound reasonable. And there's no way to verify what it is that they say.
Or to disprove what they say.
That's right. There's no way. The only people who can do it are the people who actually made the trades. The only people who know for sure what's going to happen next are the ones who are willing to make it happen. You see, we'll put on a trade and find ourselves in a nice monster little winner here and think, oh man, my methodology, it is just fantastic. And then the next time you get the same signal and then you don't get anything. Not only that, it's a loser. You think, oh, now you feel betrayed. You think your methodology let you down. Your methodology wasn't designed to tell you what's going to happen next on a trade-by-trade basis. No technical methodology is. That's where your expectations are not in line with the reality of the situation. That's why it's so easy to make mistakes. It's because you're expecting something from your methodology that just doesn't exist. It just doesn't. It never did. on a trade-by-trade basis. They will tell you what will happen. Let's say, I don't want to use the words to happen next. They'll tell you what will happen over a series of trades on a percentage basis. This particular pattern will emerge X number of times, and when it does, there's a higher probability of this happening than that. If I limit my risk when I take the trade, and my profits, my profit potential is at least 1 or 2 or 3 times greater than what I need to risk, then over a series of trades, I will be a consistent winner. That's what trading is all about, guys, as a passive technical trader. Unless you're doing this other stuff, I just said it right then and there. I said it all right then and there.